So, this is the continuation of the balance part of SLFRS 16 leases. So, we have discussed the definition of a lease agreement and how we identify whether it is a lease or whether an arrangement contains a lease. Now, as we started discussing at the end of the previous session, we are supposed to recognize two kinds of leases. The standard does not specify two leases, but for our convenience there are two kinds of leases. For the leases where the lease term is less than 1 year's time or 1 year's time, and the leases of which the values are of a insignificant amount, the right of use asset and the correspondent lease liabilities need not to be recognized. Other than those two instances, everywhere else SLFRS 16 requires us to recognize the right of use asset and the lease liability. So, let us see how the right of use asset and the lease liabilities are recognized, and you must remember one small thing as I explained in the previous session. The asset to be recognized here is not the underlying asset. Now, say for an example, if you enter into a lease agreement to lease a building, it is not the building that we are going to recognize into the balance sheet of the lessee. So, what is it? It is the right granted by the lessor to the lessee to use the building over the lease period that is recognized as an asset into the balance sheet of the lessee. So, even irrespective of the nature of the asset that we take under the lease agreement, we commonly recognize the right of use asset. It is not the underlying asset that is to be, it is not the building that we will recognize into the balance sheet, it is not the machineries that we recognize into the balance, it is not the vehicles that we recognize into the balance sheet. So, irrespective of the nature of the asset, it is the right of use asset that is to be recognized into the balance sheet everywhere if it is a lease which does not fall into either a lease of a short term or a lease of which the value is of an insignificant amount. And of these two items of lease asset, right of use asset rather, and the lease liability, you need to first determine the lease liability, and let us see how the lease liability should be determined. As you can see for yourself now, to calculate the lease liability, you need to calculate the present value of the lease payments. And to calculate the present value, as all of you all know, we should have the discounting rate, the interest rate. So, how do we determine interest rate? Just let me tell you it right away, and then we can get on with the balance part. Now, interest rate can be sometimes explicit. What do you mean by explicit interest rate? And you need not to do any calculations to determine the interest rate. It is everything clear and it is openly given in the lease agreement. Lease agreement verbally says the interest rate for a year is 10% and so on and so forth. It is openly given, explicitly given, so it is very simple. You need not to perform any other calculations to determine the interest rate. Where the interest rate is not given, then somehow or other you need to determine the interest rate. And how do we determine the interest rate? Then we call it implicit interest rate, implicit. It is not stated openly, it is not stated straight in the lease agreement. Somewhere in the lease agreement it is hidden, but it is not explicit. At a glance you do not know what the rate is. Maybe sometimes you have to do some calculations to identify, to determine the interest rate. So, we call it then implicit interest rate. And even where the implicit interest rate is not determinable, you need to determine interest rate by taking the incremental borrowing rate, incremental borrowing interest rate, incremental borrowing interest rate, right. Now, implicit interest rate is any rate that will make the present value of the future lease payments equal to the asset value as of now. Interest rate is any rate that will make the future lease payments equal to that will make the present value of the future lease payments equal to the assets fair value as of today. So, then say for a small example, asset value is 20,000 rupees and the lessor is asking you to pay 11,000 rupees in 1 year's time and 12,100 in 2 years' time, and nothing else is there. So, interest rate implicit in the lease is any lease which will make the present value of the future lease payments equal to the fair value of the asset. Now, in order for us to determine the present value, you can divide it by 1 plus r. This is 1 plus r to the power 2 is equal to 20,000. It's just a small matter of you simplifying this formula and to find out what r is, and that r should be equal to what? Implicit interest rate. Even implicit interest rate is not determinable, then you can use borrowing incremental borrowing interest rate of the lessee. What does it say? Now, you will walk into a bank to apply for a loan of 20,000 rupees to which the underlying asset will be offered as a security, and the loan repayment period should be similar to the lease term. Now, in a lease also it is like you giving the asset as a security and obtaining a finance facility. Similarly, just discuss with the bank what the interest rate has to be for you for a finance facility where the same asset is offered as a security and the loan term should be similar to the lease period, and just ask from the bank what interest the bank would grant you the loan at, and that has to be the incremental borrowing interest rate, and that is how you derive the interest rate in a lease contract for you to determine the present value of the lease liability. And now what you can do is, you need to first determine the present value of the lease liability. That is what you should first determine, and then you will determine the right of use asset. So, let me tell you how the lease liability should be determined. So, there can be fixed payments. So, irrespective of the interest rate, irrespective of the usage, irrespective of the passage of time, the lessor would have agreed to charge the fixed amount, which is once and for all fixed right throughout the whole lease period from the lessee, and that is what you mean by the fixed payment. Say for an example, the lease term is for 5 years time and the lessor is going to charge 100,000 rupees from the lessee, irrespective of the usage, irrespective of the age of the asset, irrespective of the interest rate, and this will be fixed once and for all over the entire lease term, 100,000. We call it fixed interest rate. Variable interest rate may be an additional payment which the lessee becomes liable to pay to the lessee depending on the interest rate, depending on the index price indexes, or depending on the usage pattern of the asset. So, we will take some questions into we will do lot of questions depending on the availability of the time. So, basically fixed payment is going to be the payments which the lessee agreed and has undertaken to pay once and for all it is fixed once and for all over the lease term, does not vary depending on any criteria, but variable payments, as the name suggests, should be an additional payment that the lessee becomes liable to pay to the lessee, and that keeps changing based on the interest rate price index and the usage of the asset and so on and so forth. Exercise price of the purchase option. Exercise price of the purchase option. Now, if the lessor has given a purchase option to the lessee, end of the lease term, the lessee has the option to purchase the asset on his own, and if the lessee decides to exercise the purchase option, there is another payment which the lessee is supposed to pay to the lessor besides the fixed payments and the variable payments. So, you should include that payments into the lease liability. Exercise price of the purchase option should be included into the lease liability only if it is probable and certain that the lessee will exercise the purchase option. So, you need to assess that probability, you need to assess that the likelihood of the lessee exercising the purchase option to purchase the asset at the end of the lease term, and based on that only you should include that purchase option price into the lease liability, if not just leave it aside. Now, say for an example, say lease term is 10 years time and we are charging 500,000 rupees for a month as the rental, and we promise to transfer the asset to the lessee at 5 million rupees end of the lease term if the lessee wants to buy the asset on his own, and this same asset has a market value of 50 million rupees in the market. Market value of the property is estimated to be 50 million, whereas the lessee is given the option to buy the asset at just 5 million rupees. And also some factors have to be taken into account, and all the material suppliers of this lessee are within the close proximity of the building. So, the lessee is very much certain of exercising the purchase option to purchase the asset under the lease term, and then we know the lessee is very much likely of exercising the purchase option to buy that, and then we will include the purchase price of the asset of the lessee end of the lease term. So, you should include that only as a result of your assessment as to how probable the lessee is in exercising the purchase option to purchase the asset at the end of the lease term. Then there can be some options to terminate the lease agreement before the expiry of the lease term. Lease term is for 10 years time. After 5 years, before 5 years, neither party can terminate the contract, but after 5 years time, by informing to the other party, one party can terminate the lease contract, but if the lessee decides to terminate the lease contract prior to the expiry, he has to make a penalty payment. Then again you should include that into account only if the lessee is certain of exercising the option to terminate the lease contract prior to the expiry. So, if it is not certain, please leave it aside. Not that we can include everything, all the payments into one lease liability, depends on what the probabilities are. Expected residual value guaranteed. It is like this. Now, there can be guaranteed residual value by the lessee or by a party related to the lessee. That guaranteed will be given to the lessor either by the lessee himself or by a party related to the lessee. Now, let me explain. Asset value is 50,000 rupees and the lessee wants to start a business from the scratch and it is still at the primitive stage where the lessee can't afford to pay big amount of rentals during the first few years. Then the lessee negotiates with the lessor. The lessor says your rental for a year will be something like 15,000 rupees a year, and lessee explains, look here, can you give me a small rental annually so that I can pay it without defaulting, without being in arrears, and I am pretty sure my business will pick up in few years time. So then at the end of the lease term, say it is 5 years time, whatever the lessor has not been able to recover from the lessee in terms of in form of the lease installments, can recover it at once and for all at once from the lessee at the end of the lease term. Now, lessee is paying only 5,000 rupee rental to the lessor every year, and that is not the full settlement of the asset value in form of the rentals, and we will forget about now this 5,000 is not only for the payment of the asset, also that is including the interest as well. Now 5,000 into 5 will be 25,000, say out of 25,000, 5,000 was interest component, for the asset it has been 20,000. So the lessor has recovered only 20,000 of the asset in form of the rentals over 5 years, and whatever the lessor has not been able to recover in form of the lease rentals, installments over the lease term, will recover the balance amount at once at the end of the lease term, say it's 30,000 rupees. Now this is what the lessee agrees to pay to the lessor at once. This residual value which the lessee has still not paid in form of the lease rentals will be settled at once and for all at the end of the lease term, 30,000 rupees, and this is what you call guaranteed residual value. So you must take the fixed payments into account, you must take the variable payments into account, and you must take the exercise price of the purchase options into account if it is certain and probable. You must take the penalty payments in case of the lease agreement being terminated before the expiry of the lease term into account in determining the lease liability. Also you must take into account guaranteed residual values of the lessee to the lessor end of the lease term, and this total is called the lease liability, and you must take the present value after being discounted by whatever the method of deciding the interest rate, apply the interest rate and then to discount it and take the present value of the lease liability. And that lease liability is credited to the lease liability account. This is the initial measurement of the lease liability. But in addition to the components included already in the lease liability, there can be some other components to be included into the right of use asset. For us to determine the value of the right of use asset, the first item to be included should be lease liability. Lease liability. On top of that, we will include initial direct cost. Initial direct cost. You know, in entering into a lease contract, there can be some direct cost involved, directly attributable cost. Say for an example, there can be legal charges. Directly attributable cost incurred in entering into a lease agreement can be added to the cost of the asset, right of use asset. You must remember, for that to be included to the asset value, that is supposed to be a directly attributable cost. How do we determine whether it is directly attributable or not? It is a cost to be incurred only if the asset is purchased. I mean, only if you enter into the lease agreement. You enter into the lease agreement, the cost incurs. You do not decide to enter into the lease agreement, the cost does not arise. So, that is directly attributable. You decide to enter into the lease agreement, legal charges arise. You do not decide to enter into the lease agreement, legal charges do not arise. Directly attributable. Administration cost, you decide to enter into the lease agreement, administration cost arises. You decide or do not decide does not change the administration cost, irrespective of whether you decide to enter into the lease agreement or you do not decide to enter into lease agreement. You can't stop the administration cost from arising, and that administration cost has not to be a part and parcel of directly attributable cost. Just leave it aside, it cannot be added to the value of right of use asset. Then expected cost for dismantling, restoring asset. Now, just for a small example, a chain of supermarkets will enter into a lease contract with an owner of a land to take the right of use of the land over 10 years time, and it was a bare land. And the lessee said, look, we would construct a building on the land, and the lessor said, I don't mind you doing any damn thing on the land, but make sure in 10 years time as you return the land back to me, I want the land at its original conditions. There was a mango tree, I want the mango tree back in 10 years. There were 2 coconut trees, I want the 2 coconut trees back, not young trees, and they must be 10 years old. And the lessee agreed. So then lessee is now putting up constructions for him to run his business on the building, and this construction has only 10 years lifetime. Why? As the land is to be returned back to the owner in 10 years, then they have to remove this property, they have to remove this building from the land. So, what do we call it? Removal cost is there. Removal cost is there. That removal cost is called dismantling cost, and you would have heard this word before in LK 16 property, plant and equipment, or even LK 37 provisions, contingent assets and contingent liabilities. And when the lessee put up this building on the land of the lessor, there would have been some damages, and there was a mango tree that was cut and it has fallen down, and there were 2 coconut trees, they have been fallen down, and also there is a massive concrete beam buried underneath the ground before putting up this building, and even those concrete beams need to be removed, and there will be kind of a pit on the land after removing the concrete beams and the pillars, and those pits need to be filled to restore the site to the previous conditions, to make it look afresh. And that repairing cost to the land, development cost of the land is called decommissioning cost. So, now these removal cost, expected cost of dismantling and restoring. Restoring cost is called decommissioning cost, removal cost is called dismantling cost, and even those costs are included to the cost of the right of use asset. So, as a result, right of use asset will be little bigger than the value of the present value of the liability. So, this is how you decide the value of the liability plus the value of right of use assets, and let us work out a simple example to work out these two components and also see how you will do the accounting part of it.
An entity acquired an asset under a lease agreement of 5 years period, annual rental is 527,594.9 and accrue at the end of each year. Guarantee residual value is rupees 805,255. The interest rate implicit in the lease is 10%. The entity incurs a direct cost of rupees 200,000 to obtain the lease, of which 150,000 relates to a payment to the former tenant occupying the asset, and rupees 50,000 relates to a commission paid to an agent and lessor reimburse rupees 50,000. Decommissioning cost is rupees 322,102. Now, first is to determine the lease liability, and in arriving at the lease liability, let us take the fixed payments. Over the lease term, how much is the lessee supposed to pay irrespective of interest rate, indexes and usage of the asset? 527,594. 527,594.9. Now, how many payments are there through and through? There are 5 payments, so you need to keep discounting 5 times, which is a cumbersome exercise. So, might as well to use a shortcut method. Always remember, shortcut methods are all right. At the exam you can apply them, but also remember, in every shortcut there can be a short circuit as well, but be careful. So, without keep discounting it at 5 times, which is cumbersome and time wasting, let me apply the annuity factor 1 minus 1 plus r, r is 10%, 1.1 to the power minus 5 divided by r, r is 10%. And variable payments are not there. The payments that are variable based on the interest rates or indexes or usage of the assets are the variable payments, which are not there in the question, just leave it out. And the exercise price of the purchase option, even that part has not been given, just for the simplicity. Penalty for terminating, even terminations options are not included in this given lease agreement, just forget about it. Expected residual value, guaranteed residual value is given. How much? Guaranteed residual value is 805,255, and this is also be discounted at 1.1, right. Then, if you simplify this, the final answer will be 2.5 million rupees, and that is the present value of the lease liability. Now, in case, in a separate question, you were supposed to determine the interest rate implicit in the lease without the rate being given. All the facts were given in the question asking the interest rate in the lease to be calculated. Then what you can do is, the examiner has to give you asset value to be 2.5 million rupees. This is equated 527,594.9. 1 minus 1.1 to the power minus 5. I made a mistake. This is 1 plus r divided by r plus 805,255 divided by 1 plus r to the power 5. And you need to simplify this formula to find out what r should be. And you cannot solve this equation, it is too hard. Instead, what you can do is, in order for us to find out r, here you need to work out IRR. IRR will be equal to interest rate implicit in the lease. So, that is how the question can be set if the examiner requires you to calculate the interest rate implicit in the lease. Now, this is the other way. Here the lease liability was determined to be 2.5 million rupees. Let us work out on the asset value now. Asset value has to be calculated first by taking the lease liability. Lease liability is 2.5 million rupees. So, what else to be included? Initial direct cost. So, the lessee has incurred initial direct cost. It has to be directly attributable cost. Direct cost 200,000 rupees. Out of 200,000, 150,000 has been paid to the previous tenants by the lessee, and the 50,000 has been the commission payment to an agent who found the asset for the lessee, and of this 200,000, lessor has agreed to reimburse 50,000, and that need to be deducted. Reimbursement by the lessor, and apart from these also you need to include plus decommissioning and dismantling cost of the asset, that is also given 322,102. It is discounted by 10% interest rates, and let us work it out, and that will be another 200,000. So, the asset value, right of use asset value has to be how much? 2,850,000. This is how you work it out. And then if you want to update your accounts throughout the lease term, let me do it as well, but not for all the 5-year period. To some extent I will guide you, and you can continue with the remaining years. Right of use asset, lease liability. Liability got credited at 2.5 million rupees, debited to right of use asset. Lease liability 2.5 million. Here 200,000 direct cost, and there is a reimbursement of 50,000, and then decommissioning cost is another 200,000 rupees. Now, let us see how you maintain this lease liability account over the rest of the lease term. Here you recognize lease interest 250,000, that is at 10% on 2.5, and then you make the first installment 527,594. Let me forget about the decimals for the convenience. Balance becomes 2,222,406. 2,222,406. Then you recognize interest to the second year, that is 10% on outstanding liability, 2,222,406 into 10%, 222,240. As and when you settle the installments, you credit cash and debit to lease liability account, and take the closing balance end of the second year 1,917,052. Balance 1,917,052. Recognize interest now to the second year 191,705, and let us make the payment of the third year 527,594 and recognize or calculate the balance end of the third year 1,581,163. Balance 1,581,163. Let us recognize interest to the fourth year. It is 10% on this outstanding liability of 1,581,163. It is 158,116. And let us make the payment for the fourth year 527,594 and take the balance of the liability end of the fourth year 1,211,685, 1,211,685. Recognize interest now to the last year 121,168 and pay the installment for the last year, and then the balance has to be 805,255. This is the residual value which the lessee has guaranteed to pay, and if the lessee makes the balance payment of residual value and the liability value becomes 0. Here asset value becomes 2,850,000. 2,850,000. How are we going to subsequently measure right of use asset? Subsequent measurement. Subsequent measurement. SLFRS 16 proposes two methods for the subsequent measurement. So, what do you mean by subsequent measurement? Determining the value of the asset for the purpose of presenting that in the balance sheet. SLFRS 16 proposes two methods for the subsequent measurement. Either you can apply cost model or you can apply revaluation model. Revaluation model. And these two terms have a deeper sense and a meaning. You can't use the word just for the sake of using it. You need to mean it. What do you mean by the cost? Cost model is recognizing the asset at cost first and then showing that in the balance sheet after deducting the depreciation accumulated on the cost. Revaluation model is what? Recognizing the asset at cost first and then showing the asset in the balance sheet at the market value after being revalued and after deducting accumulated depreciation on the revalued amount of the asset. So, here if I decide to apply cost model to show this asset in the balance sheet end of the first year, say ROU asset will be 2,850,000 and what has to be the lifetime of the asset? Simply 5 years, and you need to depreciate the asset over 5 years time, and let us work out depreciation. 2,850,000 divided by 5, 570,000 should be cumulative depreciation, and the balancing figure has to be the carrying value 2,280,000. This is under cost model. When it says the cost model, original cost of the asset minus accumulated depreciation determined on the cost of the asset. Revaluation method model, then end of the first year, if you decide to recognize the asset at revaluation model, you need to revalue it and then show it in the balance sheet after deducting the cumulative depreciation charged on the revalued amount. That is the same thing as you learned in LK 16 property, plant and equipment. I must add something to this. SLFRS 16 is hell of a heavy and a bulky standard, and now that I am doing a comprehensive job within this given time period, I am doing just the critical points only, and to do a comprehensive job you need at least 12 hours. Here let me talk about the subsequent measurement of liabilities in a little while. I am now talking about the subsequent measurement of ROU asset. Now say company A has given an asset under a lease agreement to B, and in return B has given this lease, given this asset under another lease agreement to C. So, there are two lease agreements for the same asset. Now, just imagine you being in the books of company B. Obviously, company B has recognized ROU asset and lease liability, and say this is a building. Company B has taken a building on rent first, and then company B has rented that building back to another party under another lease agreement. Then the examiner in the exam can ask a question: can the property be investment properties in the books of company B? So, you all have to be extremely careful in answering the question. Sometimes the examiner can set some traps and you will get caught. Don't panic, don't hurry. If you hurry, you have to worry sometimes. Now, I am just connecting this to LKS 40 as well. LKS 40 says, a property interest held under a lease agreement can be investment properties provided two requirements are fulfilled. What are the two requirements? First and foremost, it has to fulfill the definition of an investment property. What is the definition of an investment property? It has to be a building or a land held to generate rental of a capital appreciation. Now, that satisfies the definition of an investment property. Why? B is holding this interest in the property to generate rental from C. So, that satisfies the definition of investment property, is no issue. Second requirement, for that to be an investment property in the books of company B, you should apply fair value model. Now, let me take the same example I took before. In the example I just completed doing, the right of use asset was how much? 2,850,000, and I showed this property in the books. Say that was in the books of B, and depreciation figure was 570. I have adopted cost model in subsequently measuring this ROU asset. So, now can this property be investment properties in the books of company B? For that to be an investment property in the books of company B, two requirements need to be fulfilled. One is that has to fulfill the definition of an investment property. Does it? Yes. Second, fair value model would have been used by the entity for the subsequent measurement. So, the method I have adopted already is the fair value model or the cost model. This is the cost model, so it does not become investment properties for company B. Then what I did was, say I have decided to apply revaluation model for the subsequent measurement, and the book value end of the first year will be how much? 0, this is 8, this is 2,280,000, and the fair value has been 2.5 million rupees. 2.5, what is the difference? Difference is 220. How did I take 220? Book value is 2,280,000, market value, fair value is 2.5 million. Difference is 220, debited asset and credited to equity, which is a reserve,
and that is revaluation model. Can this property be investment properties in the books of company B? Cannot. Why? Two requirements need to be fulfilled. First, it has to fulfill the definition of investment property. That is done and dusted, no issue. Second requirement is what? You need to make sure the entity applies fair value model for the subsequent measurement. So, is it the fair value model the entity has adopted? No, it is the revaluation model. Still, this is not investment properties. Then the entity has adopted fair value model. Under fair value model, what happens? You recognize the asset at fair value in the balance sheet. Fair value changes, ups and downs either way, are recognized not to equity but to profit and loss. And under fair value model, assets are depreciated or are not depreciated? Are not depreciated. So, if you contrast a revaluation model and fair value model, there are two differences. Under revaluation model, gains are to equity. Under fair value model, gains and losses both are to profit and loss. Under revaluation model, assets are depreciated. Under fair value model, assets are not depreciated. So, that is how you differentiate fair value model from revaluation model. Here, fair value changes are recognized to profit and loss, and the entity does not depreciate the asset. So, the method they have adopted seems to be the fair value model. Now, only the property can be investment properties. Remember, these areas have been tested in your past papers. In 2018, as far as I can remember, December, the examiner has given a very good question from this area. So, you need to be smart. So, either the entity can adopt cost model for subsequent measurement, or the entity can adopt the revaluation model for subsequent measurement of ROU asset. And if the entity has to recognize it under investment property, make sure the entity has released it to another party, and suppose that is a building or a land, and also the entity has adopted not the cost model, not the revaluation model either, the entity has adopted fair value model. So, the property becomes investment property. Then let me explain how ROU assets are depreciated. Assets are depreciated. ROU assets are depreciated. Now, ROU asset 2.5 million rupees. Lease term 5 years. Economic lifetime of the asset. Economic lifetime of the asset 10 years. Right. Now, the lease agreement provides a purchase option to the lessee, and the lessee is very much likely of exercising the purchase option at the end of the lease term. In case a purchase option being granted to the lessee and the lessee being very much likely of exercising the purchase option, what it says is even after the expiry of the lease term, which is 5 years time, the lessee continues to use the asset. So, what is the entire lifespan of the asset? The entire lifespan of the asset is how many years? 10 years. Economic lifetime. Economic lifetime can be different from useful lifetime. Useful lifetime is the period over which an entity expects to use an asset. Say for an example, an asset will live under the sun over 10 years. That is like your lifetime.
you will be born in say 1990 and you will live for 80 years and that is your entire economic lifetime. But somebody will be expecting to use the asset only for 10 years time and that is the useful lifetime. So, the economic lifetime is defined from the perspective of the asset, whereas useful lifetime has to be assessed based on the perspective of the user, taking into account for how long the user expects to use the asset. Now, economic lifetime seems to be 10 years time, that is the lifespan from the birth of the asset right up to the death of the asset. Lease term is 5 years time, end of the lease term which is 5 years time, the lessee is going to exercise the purchase option to buy the asset on his own. So, that indicates the fact that even after the expiry of the lease term, the lessee continues to use the asset. Then SLFRS 16 requires us to depreciate the asset over the economic lifetime, that is 10 years. So, then divided by 10, annual depreciation should be 250. And also in the lease agreement explicitly it provides that the legal title of the asset passes to the lessee end of the lease. That is also possible. Without a purchase option being granted to the lessee, the lease agreement explicitly provides that the legal title passes to the lessee end of the lease term. So, once again the same principle applies. Even after the expiry of the lease term, the lessee continues to use the asset. So, you should start depreciating the asset not over the lease term of 5 years, and that has to be at a stretch of 10 years. Then annual depreciation should be 250,000. So, if it is an instance where neither lessee has been given the purchase option, no, legal title passes to the lessee end of the lease term. Right. Lease term is 5 years time and economic lifetime is 10 years. Obviously, invariably in 5 years time, when the lease agreement expires, the lessee has to return the asset back to the lessor. So, the lessee can make the best use of the asset only for how many years time? 5 years time, and then you should depreciate the asset only over 5 years time. Take the other way, lease term is now 10 years time, whereas economic lifetime is just 5 years time. It is not practical sometimes, but that is what the standard says. Even if the lease term is 10 years, can the lessee make the best use of the asset over 10 years at a stretch? No. Why? The asset is dying in 5 years, it is buried underneath the ground, it is dead and gone in 5 years. So, whatever the lessee does with the asset, he can do it only over 5 years. The lessee can optimize the use of the asset only over 5 years time. Then again the lessee has to depreciate the asset over how many years time? 5 years time. So, this is the principle. Now, if a purchase option has been given to the lessee and the lessee is very much likely of exercising the purchase option, or if the lease agreement provides the legal title to pass to the lessee under the lease term, indiscriminately you can start depreciating the asset over the economic lifetime. But where neither the lessee has been given the purchase option to purchase, no, the legal title passes to the lessee end of the lease term, then you should start depreciating the asset over the lower of economic lifetime and the lease term. So, that is what the standard says as far as the depreciation period is concerned of the right of use assets. And then let me quickly go to variable payments. So, it says an entity enters into a 10-year lease of property with annual lease payments of rupees 50,000 payable at the beginning of each year. The lease payments increase in every 2 years on the basis of the increase in the price index for the preceding 24 months. Price index was 125 at the commencement and 135 at the beginning of the third year. Interest rate is 5%. So, there is no purchase option being granted to the lessee, no termination options, no guarantee residual values. So, things are very clear. Just for the purpose of making that so simple, only for me to impress this theory of variable considerations being included in our calculations. Now, at the beginning you need to recognize right of use asset plus lease liability. How will you determine the lease liability? First, you need to calculate the present values of the lease payments where only the fixed considerations are taken into account at the beginning. Why? The variable considerations comes into effect only once in every 2 years time. So, at the beginning, at the inception of the lease, it has to be 50,000 fixed considerations into the annuity factor. Since the rentals are paid at the beginning of each year, the annuity factor is little different from the previous method we did. 1 minus 1 plus r to the power minus n divided by r. This is once again multiplied by 1 plus r. So, if you simplify this, 1.05 to the power minus 10 it has to be 405,391. 405,391. Debit to right of use asset 405,391. And you should update your lease liability over 2 years. So, the rentals are paid at the beginning, right at the inception of the lease here. The first payment should be paid credit cash and debit to lease liability. So, the interest calculations for the first year should not be on 405,391, but 405,391 minus 50,000, and interest for the first year should be 17,769. Close up the account and then you can determine the balance. Balance end of the first year should be 373, 160, and again you pay the second installment here 50,000 and recognize interest on 373, 160 minus 50,000 at 5%. So, that is 16,158, 16,158, and make sure my calculations were correct. 373, 160 minus 50,000 into 5% is 16,158. So, that balance becomes 339,318. Now, we are at the beginning of the third year. The lease rentals keep changing based on the price index. At the time of entering into the lease contract, the price index was 125, and this rentals keep being adjusted once in every 2 years time based on the price index for the 24 months preceding period. So, it has now been revised from 125 to 135. So, let me rework my lease rental 50,000 divided by 125 into 135. So, invariably that has to be 54,000. Just make sure my figures are correct. 50,000 divided by 125 into 135, 54 right now. How many payments are left? How many payments are left? Now, already 2 payments were done and dusted. Out of 10 payments, 2 were done, another 8 payments are remaining. So, you need to rework your lease liabilities present value not on the basis of 50,000 rental, but on the basis of 54,000 rentals. So, let us work out the present value of our lease liability at the beginning of the third year. Now, here 54,000 into the annuity factor, interest rates remains the same at 5%, 1 minus 1.05 to the power minus 8, the remaining number of years divided by 0.05. Once again it is multiplied by 1.05. This is how the annuity factor is calculated if the rentals accrue at the beginning of each year. So, let me work it out. 1.05 to the power minus 8 divided by 0.5 into 1.05 into 54,000. So, the lease liability should be 366,464. What is the balance now? 366,464. What is the balance now? 318. Difference is how much? This is 6, this is 4, this is 1, this is 7, this is 2, 27,146. You should credit that to lease liability. If you update the account, liability account for the third year as well, you should pay not just 50,000, now 54,000, and then calculate interest for the third year. 339,318 plus 27,146 minus 54,000 into 5%. So, how much of interest to be recognized now to the third year? 15,623. So, that is how it works when there are variable considerations. Subsequent measurement of lease liability. We have taken the initial present value and you need to keep charging interest at interest rate. Interest should be charged. As and when the settlements are done, lease liability keeps reducing minus settlements. Settlements are deducted, and sometimes certain adjustments are required for the remeasurement of the liability, like what we did in the previous example. For variable considerations, there was an adjustment to the lease liability, plus or minus readjustments, and this is how the liability should be measured subsequently. This is exactly what we did in the previous example. Then let us look at another important concept here. There can be non-lease components. Non-lease components. C. Separating components of a contract, identifications of lease components. If a contract contains a lease and entity is required to account for each lease component within the contract as a lease separately from non-lease components of the contract, the right to use an underlying asset is a separate lease component. If both are satisfied, the lease can benefit from use of the underlying asset either on its own or together with other resources that are readily available to the lessee. Readily available resources are goods or services that are sold or leased separately, or resources that the lessee has already obtained, and the underlying asset is neither highly dependent on nor highly interrelated with the other underlying assets in the contract. Now, you need to recall your memories of SLFRS 15. How the performance obligations were identified. This is not as comprehensive as that, but you need to see kind of connectivity between how you identified performance obligations in SLFRS 15 and identifying lease components and non-lease components in SLFRS 16. Now, lessor has been A and the lessee has been B. B takes an asset, say a machine, under a lease agreement. Apart from A conveying the right to use the asset over a specified time, say 5 years time, A also agrees to provide the required maintenance services of the asset over 5 years time. And just imagine this machine being a machine of a common nature, for which there are many suppliers in the market. You can find as many suppliers as you want. There are so many suppliers who sell the machine with the services. If you want, you can buy the machine and you can take the services from someone else. Why so many suppliers are there who only sell the machine in isolation, also who provide the maintenance services in isolation. So then, if you apply SLFRS 15, I don't ask you to apply SLFRS 15 here, but it's the same as you applying SLFRS 15. Lessee can benefit only from the machine without receiving the maintenance services, and the lessee can benefit only from the maintenance services without the machine, because the lessee can take the machine from the lessor and take the services from someone else in the market, because we have a market for that. Also, the lessee can take the services only from the lessee, and then he can take the machine from another party. Wise, there are so many sellers and parties who only sell the assets without the services being provided. So then, if the rental has been 500,000 rupees for a year, and if the lessor is charging 500,000 rupees as part of the rental, as part of the maintenance, then before you calculate the lease liability present value calculation, the service attributable or the amount attributable to the service has to be removed from 500,000. If not, you finally calculate the lease liability with the values of the maintenance over 5 years time, and that will eventually capitalize to the asset as well. Then that will be contradicting LK16. Why LK16 does not require us to capitalize maintenance cost, and you need to be careful. How do we separate out the lease components and non-lease components? Very simple. You can again apply SLFRS 15 knowledge. You can remember how you segregated the transaction price among different performance obligations. You can use the market information. Basically, we are using standalone prices. Standalone prices can be of different categories: market price, adjusted market price, cost plus markup, and residual approach. Here, if you first look at the fair value of non-lease component. If only the services are received from any supplier without the asset being purchased in a standalone service providing transaction, the maintenance cost will be 100,000 rupees. This is the market approach. Not that we look at the fair value of a separate asset purchase transaction. No, that's not what the standard wants you to look at. The standard wants you to look at what the fair value has to be of the service component in the market in a standalone service providing transaction. It is 100,000. Then out of 500,000, you should remove 100,000 rupees, and only the 400,000 rupees will be taken as the amount attributable to the lease components, and this is what you will take to determine the present value of the lease liability. Now, this will enable you to keep the maintenance cost away from the liability as well as the assets. If not, what happens is you will take entire 500,000 rupees to calculate the present value of the lease liability. Eventually, that will be part of the right of use asset as well, where even the maintenance cost has got capitalized as part of the cost of asset, and that is completely contradicting to the requirements of LK 16. So, the standards have been developed in such a way, the standards are not contradicting among each other. If not, there is no consistency. I think the things were clear. So, you can have another questions. I won't work it out, but if you want to do a questions alone, and this is a question, and you can just note it down and you can do it alone, very simple one. So, there are 3 lease components, also 3 non-lease components, and you need to separate out non-lease components from the lease components based on the market informations, and you can do it alone. Then, as I said in the session 1, right of use assets are not required to be recognized. Lease liabilities are not required to be recognized for the leases of a short term nature and for the leases for which the underlying asset is of an insignificant amount. Short term leases are the leases where the lease term can be 1 year or less than 1 year's time, and leases of which the values are of an insignificant amount have not been specified as to what these insignificant amounts are in the standard SLFRS 16. So, that will be that is quite subjective to the magnitude of the total assets value in the balance sheet. So, there is no universally accepted hard and fast rules. So, that is up to the management to decide what is significant and what is not. So, let us see how you recognize the leases where the values are of an insignificant amount and the leases of a short term nature. Now, simply what you can do is, but before that I must remind you one small point. If the lessor has given a purchase option
to the lessee to purchase the asset end of the lease term, please, that will never be taken as a short term lease. And you must remember that the examiner can start checking on these tiny points, but that will carry a lot at the exam. Where the lessor has granted a purchase option to the lessee, and that will never be considered to be a short term lease. In other words, where there is a purchase option being granted to the lessee to buy the asset under the lease term, you inevitably should recognize right of use asset plus the lease liability. So, in the questions within the context, you need to find whether a purchase option has been granted. If it is granted, whether you like or not, you should go ahead to recognize right of use asset and the lease liability. Then simply, if it is a short term lease, it is either 1 year's time or less than 1 year's time, you need not to do anything but to expense the rental to the profit and loss just within 1 year. Just within 1 year there can be maximum 12 months period. So, there is no any other requirement other than the rentals accrued during the period being expensed to the profit and loss as an expenditure. But sometimes it can be a lease more than 1 year's time, what values are considered to be of an insignificant amount. It is more than 1 year, but the values are considered to be insignificant. Then how will you recognize it? Once again, what you must do is to recognize the lease only by expensing the rentals accrued for the period. What is the method? If another method is preferable, if another method is not preferable, rather, you should expense the accrued lease rentals on straight line method to profit and loss. If you can't justify another method is more preferable, the lease rentals accrued during the period should be expensed on straight line method, and let me explain a small example on this. Lease term 5 years. Initial deposit 100,000. Monthly payment 20,000 over the first 2 years, and monthly payment should be 30,000 over the second 3-year period. And the lessor has granted 6 months grace period, a concession has been granted. So, the lessee is not required to pay the rentals during the first 6 months. Determine the expenditure for the first year. Now, apparently, the question does not provide any preferable method of the lease rentals being expensed to profit and loss. Where a preferable method is not justified, reasonably what you must do is to expense the rentals on straight line method over the lease term. So, you need to flatten these ups and downs of the payments into a straight line. you must level it. Now, how do we do that? Initial payment is 100,000 plus, and over the first 2 years the rental should be 20,000 rupees a month, but still there is a grace period. So, you need not to pay 24 months. 24 minus 6 will be how many payments? 18 payments into 20,000 plus the payments for the second 3 years time is 30,000, and how many payments are there? 36 payments, and then divided by 60 months and multiplied by 12, and then you can calculate the amount of rentals to be expensed in the first year. So, 20,000 into 18 plus 30,000 into 36 plus 100,000 divided by 12 into 6. So, the rentals to be expensed to the first year should be 308,000. $308,000. Lease modification, another important area in the standard. Now, can you remember we discussing modifications to a contract with the customers under SLFRS 50? This is something similar, not that everything is similar, a lot of discrepancies are there, but the concepts are going to be almost similar. What we do is, we will let the lease agreement continue after entering into the lease with the original terms and the conditions, but later on there can be some changes, alterations, amendments to the original terms and conditions, then which we call it a modification to a lease agreement. Certain conditions will be cut and certain provisions will be chopped, and there will be cuttings and choppings and removal and excluding and including new provisions, new terms. So, the lease agreement to continue after a particular point in time is not the original lease contract which the lessee and the lessor entered into originally. Then we call it what? Modifications of a lease. And legally, not that do we enter into a fresh lease agreement, it is the same lease agreement legally that continues, but we do not look at it from the legal viewpoint, we look at it from the substance viewpoint. So, you all being accountants will look at it differently from your from the accounting perspective, from the substance perspective. Sometimes there can be two lease agreements, though legally it is a one lease agreement to continue, in substance there can be two lease agreements. Or sometimes you will change the original terms and conditions, alter them, modify them, develop them, exclude them, include new provisions to such an extent that the lease agreement looks like a fresh one, but still in substance it looks like the same lease agreement, irrespective of however much of changes you incorporate into the
lease agreement. So, without beating about the bush, let us come to this point straight now. Certain modifications will be considered to be a separate lease agreement. Before that, I must tell you that the modifications can result in change in the scope of the lease, It can change the scope of the lease, or the modifications will result in change in the consideration of the lease. Both are considered to be modifications. Either there can be a scope change, say for an example, lessee entered into the lease contract to take one floor of a building under a lease agreement, and later he wanted another floor of the same building, and maybe sometimes without entering into a lease agreement afresh, we will continue with the same lease contract by cutting and chopping and modifying the original terms and conditions. It is a modification which is resulting in a change in the scope of the lease. Other consideration, it is not a variable consideration. Variable considerations are where you decide at the beginning to change the considerations depending on a market interest rate or price index or usage. No, that is variable considerations. Here what happens is, you once and for all decide to charge 500,000 rupees rental a year, and later on there can be changes in considerations, not because of a price index, not because of an interest rate in the market, not because of the usage, and there will be changes in the considerations. All these together are called what? Modifications of lease. Certain modifications can be considered to be a fresh lease contract, but legally there is only a single lease. Contract is the same. It is only just that we removed certain provisions and included new provisions, but still for accountants like y'all, it looks like a fresh lease agreement. And sometimes a modification can be like a continuation of the same lease contract, and these modifications can be either only a scope change, increasing or decreasing. Sometimes it can be an increase in the consideration, so it can be a decrease in the consideration. So it can be all these combinations of changing the scope, reducing and increasing the scope while changing the considerations as well. So we don't have enough time to discuss everything, but let me just discuss few points. So what are the grounds on which a modification can be considered to be a fresh lease? A lease modification should be accounted as a separate lease if both of the following apply. The modification increases the scope, and that is important. If it is a decrease in the scope, remember it is not considered to be a separate. It is obvious, no. If it is decreasing, I mean it cannot be a separate one, you have to decrease the scope of the same lease, but it has to be only an increase in the scope of the lease. The consideration for the lease increases by an amount commensurate with the standalone price for the increase in scope and any appropriate adjustments to that standalone price to reflect the circumstances of the particular contract. Now the lessor has been A and the lessor has been B. B had taken 3000 square foot floor of a building at 100,000 rupee rental a month. And just in 2-3 years time the space was not adequate and the lessee wanted another 3000 square foot floor of the same building. Now it is a scope in the lease increase, I mean that is an increase in the scope of the lease. Then if the lessor says, look here, you have been a very good tenant who used to make the rentals on time and we appreciate your prompt settlements, and a floor can be rented in the market at 150,000 rupees, by taking the fact that you have been a very good customer and a tenant of us, we thought of giving you an unprecedented discount of 50% and we are charging only 75,000 rupees as monthly rent, 50% discount that would not have been otherwise available unless the lessee had taken another floor before. So, as a result 75,000 rental does not reflect standalone market prices, and this price reduction which is of a massive amount is because of the fact that the same lessee had entered into a lease agreement before. So, then this change of lease agreement to take another floor will not be considered to be a separate lease contract. But if the lessor says it is through the fact that you have been very good and your payments were prompt in settlements, which we appreciate truly, but still we have to give you the new floor as well at the market rental will not be 100,000 rupees any longer, it is going to be 150,000 rupees. So, whether you like or not, you should pay us the new market rental, and please let us do that. So, as a result, let us see how it works now. Let us take a simple question. An entity entered into a lease of 2000 square meters for 10 years at rupees 200,000. Rentals are paid end of each year. Interest is 10%. Agreement was amended to include additional 3000 square meters at the beginning of the 4th year. At the beginning of the 4th year, and to use it for another 7 years. For another 7 years. Market rental is 300,000 rupees a year. Now, simply originally what you must do is you need to take right of use asset and lease liability based on 200,000 rental over 10 years time, 200 and take the annuity factor at 10%, and that becomes 1,228,913 debit to right of use asset and credit to lease liability. 1,228,913. So, the amendment occurs to the lease agreement when amendment occurs at the beginning of the fourth year, that is at the end of the third year. And then as per the amendment, they are going to take another 3000 square meters of space. What is the market rental? 300,000 rupees for how many years time? That is for another 7 years time. 7 years time. And then you can work out the lease liability, 300,000 into 1.1 to the power minus 7 divided by 0.1. You can work out 1.1 to the power minus 7 into 300,000. So, it is going to be another 1,460,000, 52526, and this has to be like a separate lease contract which is different from the first one. So, you again recognize another right of use asset and recognize a lease liability. You can open up another 2 accounts accordingly. And if you do a modification which is different from the previous, if you enter into, if there is another modification which is not considered to be a separate one, but is considered to be a continuation of the same lease contract, the accounting part is little different. Let me just leave it aside, if not I will not be able to discuss another important part, and quickly we will move on to another important area, and this has to be done in our discussions, if not our discussions is not complete. Say sale and lease back transactions. Sale and lease back transaction. It is a combination of 2 standards now. What are the 2 standards which are going to be combined? SLFRS 15, luckily we have done it, and SLFRS 16 leases, right. It is a transaction where you sell an asset first and then you reacquire the right of use to use it for another couple of years ahead. Why are these 2 standards connected here? Sale and lease back. Sale and lease back. For the sale transaction, you need to apply SLFRS 15, and for the lease back transaction only you should apply LK 16. So, you need to first make sure that the transaction is a sale, or you need to make sure the transaction is not a sale. How do we do that? Let us look at our presentation. Right. Now, a sale and lease back you need to do the accounting in the books of the lessee and the books of the lessor as well. There is a sale and there is no sale. Let me explain that part. Say seller is A, buyer is B. It is a sale transaction that should occur first. For the sale to be a genuine commercial sale transaction, what should be the requirement to be satisfied? If it is a sale, make sure the performance obligations have been satisfied. So, how do we know the performance obligations were satisfied? for the performance obligations to be satisfied under SLFRS 15, control of the asset would have passed from the seller to the buyer. Control has passed. So, first you need to apply SLFRS 15 to make sure the performance obligations were satisfied. So, how do we do that? To ensure that the performance obligations were satisfied, you need to see whether the control has passed to the buyer from the seller. Now, if it is not a sale, the seller need not to derecognize the asset, and you know that. If it is not a sale, where the control of the asset has not passed to the buyer, you should continue to recognize the asset in the books of the seller. Do not derecognize the asset. Do not derecognize the asset. Asset is continued to be recognized in the books of the seller. Then sale, legally there is a sale, and you have given the asset to the buyer and reacquired it from the buyer, and the buyer has paid you money. There is no sale as such, because the control is still with the seller. Then how will you do the accounting for the proceeds you received from the buyer? Simply, proceeds are recognized into a financial liability, and this is recognized under SLFRS 9 and recognize the financial liability under other financial liabilities, where the initial measurement is fair value, subsequent measurement should be amortized cost. That is as far as the transaction where a sale has not taken place is concerned. No sale. If a sale has occurred, then only the problems start arising. How do we know that the sale has occurred? Performance obligations have been satisfied. How are they satisfied? By passing the control of the asset to the buyer. Then how do we do the accounting? The seller has to derecognize the asset. But recognize right of use asset and lease liability and profit or loss on sale transaction proportionately. How is it proportionated? Let us see how it is proportionated in a small question. If it is a sale transaction where the control of the asset has passed to the buyer from the seller has to derecognize the underlying asset, instead recognize right of use asset and recognize lease liability and recognize profit or loss on sale proportionate. Let us see how it is proportionated. Then we call A seller lessee. He becomes the seller as well as the lessee. The name given to him is the seller lessee. B is the buyer. We call him what now? Buyer lessor. He is not only the buyer, also the lessor. Buyer lessor and the seller lessor. You need to do the accounting in the books of the seller lessee and also the buyer lessor. We don't have enough time to discuss the accounting of either party. Let us look at the most important one, the accounting of the seller lessee when the sale is considered to be a genuine sale under SLFRS 15, where the control of the asset has passed from the seller to the buyer. on 1st January 2018, P sells an item of machine to C for its fair value of rupees 3 million. The asset had a carrying amount of rupees 1.2 million. The sale represents the satisfaction of a performance obligation. P enters into a contract with C for the right of use the asset for the next 5 years. Annual payments of rupees 500,000 due at the end of each year. Interest rate is 10%. Now, this is the accounting in the books of the seller lessee, that is company P. Let me open up underlying asset, that is a machine. What is the balance now? Carrying value is 1.2 million. And we need to open up right of use asset account, lease liability, and sale and lease back. Sale and lease back. Right. Now, the accounting changes depending on the selling price is equal to fair value or above the fair value and below the fair value, and the time is not enough to discuss all these different ways. We will take only just one where the fair value is equal to selling price, then the problems are less. Now, here you need to interpret the transactions in a different way. Selling price has been 3 million rupees, but if you gave the asset to the buyer and did not take the right to use, it's a completely a genuine absolute sale transactions, and then you can completely take the asset out of the books. But here what has happened is, having the asset been given to the buyer, you have taken the right to use it for another 5 years. It's like you retaining part of the asset with you for the use for the next 5 years ahead, then selling the balance part to another part. So, there is a partly a sale, partly a retention. Partly a sale and partly a retention. And of this 3 million considerations accordingly, part of the 3 million consideration seems to be like the sales proceeds of the part you sold, and the balance part is like a liability for the use of the asset to be repaid over 5 years. So, that is how you need to interpret. Then let me work out first the lease liability present value. How will you do that? 500,000 into 1 minus 1.1 to the power minus 5.1. So, that will be 1,895,393. Just for the convenience, let me take it as 1.9 million rupees. I am in a bit of a rush. So, lease liability should be 1.9 million rupees. How much have you received now? 3 million was the amount of consideration you received by giving the asset. Out of 3 million, 1.9 million rupees is like you making yourself liable to pay for the use of the asset for 5 years ahead. So, that 1.9 million rupees is debited to cash and credited to lease liability. But how much have you received from the buyer? 3 million rupees. Out of 3 million, 1.9 is the lease liability, and the balance 1.1 million is like the proceeds for the sale of the asset. For the sale of the asset. So, that goes to disposal account or sale and lease back account to calculate the profit or loss on sale. Then, of this 1.2 million asset value, partly you have sold and partly you have retained for the use. So, how will you calculate the right of use asset? And right of use asset is equal to 1.2 million, market price is 3 million, that was the selling price, also 3 million, and what has been the liability to be paid for retaining the right to use it, 1.9 million rupees. So, then proportionately you can calculate the value of 1.2 million rupees retained for the use for 5 years ahead. So, that becomes 760,000 rupees if the total selling price is 3 million rupees, and if the liability value is also 3 million rupees, it is like you retaining the entire 1.2 million for the use over 5 years. If the market price is 3 million, asset value in the books is 1.2, and if the liability for the use of the asset for 5 years ahead is 1.9 million rupees. So, that is like you retaining 760,000 rupees for the use over 5 years ahead, credit to asset by 760 and debit to right of use asset by 760. What is the balance? Out of 1.2 we have retained 760,000 for the use over 5 years ahead, and the balance amount 440 is like your sale, and then this is transferred to sale and lease back account 440,000. This is the sale, and then let us calculate the profit on sale. 1.1 million minus 440,000, there will be a profit of 660,000 rupees. Machine account underlying asset gets derecognized, right of use asset is in the books, and you can apply your previous method or previous knowledge regarding the subsequent measurement, either cost model or a revaluation model. For the lease liability, you need to keep updating for the settlements, interest and adjustments for like variable and for modifications, and things will continue as they are. So, we will finish our discussions of SLFRS 6. It is not a comprehensive one, lot of other areas are there. We did not completely discuss the accounting in the books of the lessor, but since if you have done it till case 17 before, it is just a matter of refreshing your knowledge, and this is the end of our webinar series of your subject ABR paper, and another lecture will start the balance series of lecturing for the revisions. And once again we appreciate your coordination, appreciate your contributions by watching our videos, and appreciate and thanks for listening and watching our